Hello traders, Bill Duryea here with Follow the Bots. Welcome to our daily trade strategy review. In our trade strategy review, we are going to go over the trade opportunities that developed during today's session. In our daily market recap, I've already addressed the market structure that assisted us in today's analysis of the market developments. Therefore, I'm not going to go into much detail on the market structure in this broadcast. I simply want to point out that following the breakout above prior resistance at 1650, the starting point of the rally, the pullback to 1641, wherein the S&P auctioned above 1670 and traded at or near its multi-year high, the market structure indicates where buying interest and selling pressure was present during the rally up to the recent high. The reason that I say at or near the multi-year high is twofold. First of all, the S&P cash index traded up to 1684 today, and the multi-year high in the cash was at 1687. In the S&P futures contract, there was a premium discount between the cash and the futures, and therefore the multi-year high is slightly below that of the cash index. We had been describing the initial up move as being the result of a short covering rally. A short covering rally is where the market trades through a previous distribution. The name short covering comes from the fact that the buying interest that appears to develop during the rally has more to do with sellers buying their positions back than it does new capital entering the market. In the context of the rally, which broke out above prior resistance, the market structure indicates two levels above the breakout point as possible candidates for pullbacks wherein the market may encounter support and attempt to auction back to the high. The classification of these levels is a scaling issue relative to the distance between the high and the pullback target. 1666, which was Thursday's low, is considered the minor pullback target based upon the distance below the current high. 1660 relative to the current high is the daily range or the Markov level pullback target. Now that we've touched upon the market structure, let's take a look at what occurred during today's session. Overnight, the S&P pulled back at or near 1674, modestly below yesterday's close, which was at or near the high of the day. Price auctioned back up to retest the prior high during the overnight session. Had you been trading during that time, that was the short opportunity. The confirmation that the market was not going to continue higher is evidenced here in the initiated or high-frequency sell surges that occurred during the retracement up to the high. As we approach today's open, the S&P pulled back at or near the overnight low. That provided an opportunity to buy the low with the expectation or the potential that the market would retest the high and potentially go on to make a higher high. The reason for thinking that the market might retest the high and or make a higher high is because the data released today, the economic data, was positive. So therefore, while not listed here, that was a trade opportunity. When the market failed to make a higher high and pulled back to retest the overnight low, initiated selling occurred as price broke down below 1674, the overnight low. This was the opportunity to sell the breakdown. Very often traders will hesitate to take this trade because they'll be thinking, oh, I missed the high, gee, if I only sold the high, oh, gee, I didn't sell the high, oh, I can't sell here. But in fact, this is a great place to sell because it is a breakdown. Now, breakdowns and breakouts often become nothing but minor probes. In other words, possibly the market was only going to come down to Monday's low and then attempt to go back to the high. And so one needs to be aware when selling a breakdown that you cannot tolerate a retracement back up into the trading range or the cluster overhead. The market has to drop precipitously or exponentially and make a sequence of lower lows and lower highs. During the breakdown below the overnight low, when price traded to Monday's low, the initiated selling accelerated. So there is more selling pressure here taking out Monday's low, and this continued all the way down until the market got at or near Thursday's target. The first downtick here at number 3 is only approximately 2 points below Friday's low, and that could be perceived as a potential probe for stops. Indeed, the market behaved that way because price upticked back to where the initiated selling had occurred before auctioning back down and trading down to Thursday's low at 1666. During the pullback to Thursday's low, the selling pressure backed away. The order flow monitor indicated here sell programs waning. Then again at the low, bids were replenished. The digital filters turned up, and the market auctioned back to where the initiated selling had occurred at or near 1672. The aggressive seller could have taken an additional short at 71 the first time the market auctioned up, anticipating a retest of the low. I myself took that short and discussed it in the live market commentary, but the better short was the short here when the market auctioned back up to where the bulk of the initiated selling occurred at or near 72. The initial up to down to action is the immediate profit. So again, depending upon one's time horizon, if you were looking for the quick opportunity, the market immediately traded from 72 down to 70, so there was 2 points to be had there initially, and or you could have placed your stop at or near the entry, anticipating that price would retest the low again, which indeed it did, and there was more than the 2-point profit to be had. The pullback or the retest of the earlier low was the opportunity that I thought was the most obvious here at number 6. The S&P traded down to 68. Sell programs waning occurred, and the market auctioned back up to 1672. In today's broadcast, I spoke about buying pullbacks, and I commented that I would spend more time this afternoon discussing that. And so I'd like to enlarge this chart now and focus our attention just on the activity that came about during the probe down to prior support. There are 2 things I would like to point out initially. First of all, looking over the market structure, Were you or were you not able to identify 1666 as the potential pullback level based upon the prior distribution? If you were not able to identify 1666 as the potential pullback target, then I would ask you to reflect, why were you unable to identify that price level? I state the question in this manner because I think it requires reflection on the part of that person who says, I had no idea why 66 would be support. So often we get hung up on indicators, mechanical means of monitoring price change like MACDs, stochastics, RSIs. All those type of indicators do is present to you different views of how price is changing. I would suggest that you consider looking at market structure as an indicator. It is an indicator in this sense, where the market, as is the case here with 1666, where the market pulls back to, where the selling pressure ends, where the market auctions up from, is an indicator. It indicates the following. Anyone who sold 67.68 made no money for doing so. They were on the wrong side of the trade. Now, quite possibly some high-frequency algos might have grabbed 3 or so ticks during this period of time, but any discretionary trader who thought, oh boy, I'm going to sell the 68s, lost money. Now, that's not my opinion. It's not an opinionated statement. It is a numerical fact. We can incorporate a certain element of game theory when we analyze markets. Game theory is derived from a social endeavor, a social activity, wherein people take opposite sides, and we can judge their decision making by the final result of what their decision produced. So just like we saw people today buying the high at 1679, the market could not have traded there unless people were buying the high. Those people were more than 10 points wrong. Therefore, their decision cannot receive the highest grade of today's score. The person who sold the high and held it till the market came down to 67.66 would get the absolute highest score, since if they traded in that manner, they made the maximum profit. Similarly, whoever decided to sell 68.67 lost money. This is not my opinion, this is the fact. So therefore, this indicates where amongst the market participants who buy and sell and trade the S&P every day, the aggressive selling group of those participants made the wrong decision, and the responsive buyers at the low made the correct decision, and that information is more valuable than the MACD turning up or the RSI reaching this or that level or a stochastic giving this or that indicator. Why? Because the MACD can turn right back down again if it chooses. Because the level in the RSI can be exceeded either above or below. Because the stochastic can reverse. Whereas here, factually, people bought. And you can see on the long-term chart that I began our discussion with that Previously, on Thursday, the market had found support here as well. Now, in evaluating price discovery, the initial stopping point at 68, 2 points below Friday's low. The result, an uptick back to 1671, where the initiated or high frequency selling had occurred. So the initial reaction to the probe at 68, 3 points. Now, can you then buy that low? Let's see. The market trades back to the low. It makes a modest lower low, but then upticks back at or near the low, allowing you the opportunity, if you became concerned because you bought too soon, to scratch the trade and break even. Now that may not sink in when you first hear that. You may think, big deal, I broke even. If you have ever had the good fortune to associate with anyone who spent their life trading on the floor at the Chicago Mercantile Exchange or the Board of Trade, and who had millions of dollars in play at any given moment in time, and made a living day in and day out, and you would hear them talk about scratching a trade as if it was manna from heaven. Why? Because when you can be involved in a dynamic process like this and make the wrong decision and adjust your thought process quickly and be out of the trade at minimum loss, that is actually a very positive thing. Whereas the person who said, "Oh, I'm going to buy here and hold," there was no hope for that person to get out of the trade gracefully, was there? It became a greater loss and a greater loss and a greater loss until finally it became a, "Oh my God, help me, I'll get out, I'll take a loss." Whereas here in a matter of minutes, "Oh, I bought the 8s, off the 8s. Try again." Low, we knew. 66. Cancel, replace, try again. That's how it has been done for over 100 years. I was very fortunate when I first started trading. By happenstance, I signed up to become a Globex terminal operator. At that time, the CME would send you out a computer, and you would hook up directly to Globex, and it was all there. You couldn't use the computer for anything else. And my computer was sent to the wrong place. It was sent to a firm called the Gelber Group, a prop firm in Chicago. And I called and spoke with them, and they said, "Yeah, it's here, and we've got it plugged in and it's connected." And they offered me the opportunity, if I wanted, to come back to Chicago and trade through them. And so I took that opportunity and was back in Chicago on and off for about a year, and had the good fortune of associating with floor traders. Now, I never stood on the floor and traded on the floor, but I learned an immense amount from that association as to how they thought and how quickly they reacted without hesitation to getting in and out of positions. And so here you have the opportunity to scratch the 8s and then buy the new low. And so when you see the market comes down, makes a lower low, upticks back to the 8s, cover, buy the new low, this is how price discovery works. This is what is called price discovery. And I would encourage you to go online and Google price discovery. Read about it. There are all kinds of papers written on this process. Very few people grasp price discovery, although the word is thrown around all the time. But it is an intrinsic part of the dual auction. Later in the day, when the market pulled back again a second time at or near the 68s, the same opportunity came into play and the same result, price trading back to 1672. Ultimately, if you held on to the 8s, it was worth 4 points. When we're brand new at trading, we have the conception in our mind that a great trade is to be the person that fills right at the last tick. This is a very low probability that you will ever be the person who fills at the very low last final tick. When you're evaluating the low, you're looking at how many contracts traded there. How many are a tick above? How many are a tick above that? And you try to find the area that has the common fill, the most likely place to fill. Whereas you may get lucky and fill right at the exact tick. More often than not, it'll trade and there'll be no fill. And then you'll miss the opportunity altogether. This is a common, prominent aspect of price discovery. I also want to quickly highlight on scaling in. Scaling in does not mean adding to a losing trade. Now, you may have a large order and be content to fill it at or near a particular price level. So in that case, you might start by buying 68 and then add to it and average in at 67 and then be willing to add to it again and average in at 66. Large orders are filled that way. Large orders are not filled at one given price. No large orders are filled that way. They're filled in a range of prices. But that means you have to be resolved to buy the low. Scaling in is when you have a target, like in this case 66 Thursday's low, but you want to be in and perhaps you start early and the market goes lower because it didn't go down to 66 at first, it stopped here. So maybe you start early and then you see it drop and you don't want to have multiple positions on, then you scratch at the very first opportunity, but you don't walk away and say, oh, that's the end. You immediately replace the order at the common fill price and get a better fill. Just like you might go to a car dealership. You want to buy a car. You've decided, I'm going to buy a car. I've got my mind set on this car. Then what happens? Now you negotiate, right? Of course, there you're dealing with one person, you're haggling, you're trying to get the best deal, you want sticker, blah, 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 right? But that's how you get the best deal. So it's the same with trading. You may have to work to get the best fill. It may not just be given to you immediately. But if you are convinced at your discretion, you decide, I want to be a buyer here, then you work the low. And when you're flat on the position, your inventory is cleared up, you're not adding to a loser, then you put the trade back on at the better price. So that's different than adding to a loser. Here's what's adding to a loser. Gee, I bought Monday's low. Oh, that didn't work, but I'm holding it. Well, I'm buying Friday's low. Oh, gee, now I'm upside down. Well, I'll buy here. Oh, God, I've got my whole account. Oh, what the... That's called adding to a loser. That's not what we're talking about when we're talking about scaling in. There are times where you may deem it in your interest to hold more than one entry through a range of prices. There are times when that may appear to be a good thing to do, particularly when the market has a very broad range and it's really volatile and prices really moving. and you see, God, it's moving so fast that you'll be able to take the earlier entry off for a small profit. Or if it has just rallied to a ridiculous high without stopping, straight up, and you sell a little early and it goes 1 or 2 points higher, maybe you'll sell again because you feel that, hey, it hasn't turned and it's just been straight up and it's due to pull back. That's a different situation. But this situation in price discovery is very common, extremely common. And so think about it, analyze it yourself, experiment with entering in that manner on your simulated dome, get a feeling for it. And then after you have had some experience on the simulated dome to where you are able to do it, this is very important, okay? You don't just do it once or twice and say, yeah, I did it on the simulated. No, you do it 100 times, 1,000 times until you can do it, until you say, okay, I've done it. Let's just say 100 times. And during the 100 times that I've tried it, 99% of the time I'm able to get out and get the better fill, and I get a nice trade off of it. And out of the 99 times or the 90 times, there's a few times where it ultimately drops lower and I wind up having to give up a point. If that's the result, that's a good, strong, positive result. It doesn't have to be 100% perfect. Now work out the math. What did you gain by re-entering? Okay? How much did you better your position? How much did you lose when you weren't able to get out? Add it up, work it out, do the math, and then you can construct a strategy. You can see if it makes any sense or not. If instead you have to trade where every trade has to have a stop, then trade that way. And then come back and look at the difference. And then see, hey, this is the first time down to a level where for 2 days we had ranges like this. 2 days running, we had ranges like this at the high, right? Yesterday was just pure hell. No opportunity, limited, restricted opportunity all day. It's the first time the market made a pullback. People are more likely to buy than to sell below here the very first time. Now that may not be the case if price doesn't go back to the high. If the market stalls here at 72 and then goes back down to 66, well, it didn't get back to the high. So that means you have a lower high, and that could possibly result in a lower low. And the best place to be in is still down at 1660. Make a note to yourself that when the market breaks 66 and trades to 1660, whether or not it auctions back up through 66, make a note about that to yourself. That when the market finally trades to 1660, does it or does it not auction back up to 66 and allow the buyers at 66 the opportunity to scratch their position? Start looking at the market from that point of view, from that perspective, and annotate what you observe. So that concludes our discussion today, our review of today's trade strategies. If you feel there are ways in which our discussions could be more beneficial, if there are things here that you think I'm not covering and you would like me to cover, then tomorrow I'm going to show you how you can enter your request in the forum, not through a support ticket, but in the forum. And in that way, we'll be able to take people's questions and come back and address them more specifically. That concludes our Trade Strategy Bulletin for July 16th. Thank you very much for your membership and your support. We'll look forward to seeing you tomorrow morning at the Open.
Follow the Bots offers a completely new approach for traders. Follow the Bots provides you with tools that will allow you to trade with the bots and not against them. To learn more, take a tour of www.followthebots.com.